Let's take a look at this problem with stock transactions and corrections of journal entries. First, I'll read Part A. During its first year of operations, the McCollum Corporation entered into the following transactions relating to shareholders' equity. The corporation was authorized to issue 100 million common shares at $1 par per share, and our first requirement is to prepare the appropriate journal entries to record each transaction. So let's start off with the January 9th transaction. The company issued 40 million shares of common for $20 each. So the calculation we need to come up with, let's put this right here, is we take the 40 million times $20 per share to come up with 800 million of proceeds, and the 40 million shares at $1 par says the legal capital is 40 million. So to come up with that transaction, then we use those two figures, and what we do is we debit cash for the proceeds of 800 million, credit common stock, which is the legal capital, for 40 million, and the difference represents paid-in capital in excess of par. Next, we'll tackle Part B. Or rather, we'll tackle the March 11th transaction. Let me put that transaction back on the screen for you. Okay, so now it's back on the screen, and on March 11th we issued 5,000 shares in exchange for custom-made equipment, and the shares traded recently at $20 per share. So the calculation we need to make looks like this. We take the 5,000 shares at $20 per share to come up with $100,000 as the value of the transaction. And again, 5,000 shares at $1 par is 5,000. That's the amount of legal capital that needs to be recorded. So the transaction we need to make to record the March 11th transaction includes a debit to equipment of $100,000, the fair value. Common stock increased by $5,000 with a credit, and the difference again credited to paid-in capital in excess of par. Next, we'll tackle Part B. Okay, now you see Part B on the screen. A new staff accountant for the McCollum Corporation recorded the following journal entries during the second year of operations. McCollum retires shares that it reacquires, restoring their status to that of authorized but unissued shares. So on January 12th we see there was a debit to land of 2 million, a credit to paid-in capital donation of land. On September 1st there was a debit of common stock of 2 million, a debit to retained earnings of 40 million, and a credit of cash of 50 million. And on December 1st an increase in cash of 26 million, a credit to common stock of 1 million, and a gain on previous sale of previously issued shares of 25 million. Well, that looks a little different to me. Why don't we record this the way we need to? And what I'll do is I'll copy the answer over here, and I may have to move it around a bit so we can see it. Okay, so the first transaction, January 12th, where we had a debit to land and a credit to paid-in capital, well, that's incorrect. The debit to land for 2 million, if that's the fair value, we'll keep that as what it should be, but the credit goes to revenue on the donation of land. That's considered an income item, most likely a one-time income event, or one-time event, and we need to record the revenue from the donation of land. On September 1st, there was a debit to common stock of 2 million, a debit to retained earnings, and a credit of 50 million. Let's slide that up and take a look at what the correct item is occurring here. Now, we'll assume the accountant recorded cash correctly. He spent $50 million to buy its own stock. What we have to do is figure out what was the value how much cash did we use. It was $50 million, and if it required $2 million of par value of stock, then we need to reduce any paid-in capital that was already recorded. And once we've reduced all the paid-in capital that was already recorded, we're assuming 38 million here, then we need to continue a debit to retained earnings to get to get the account to balance. So in this case, the purchase of treasury stock is retired. So we don't actually record treasury stock. We retire the $2 million value of common stock. We record any paid-in capital that was previously on our books, which we've done, and then if we've still had to pay more for the cash because the value is worth more than the paid-in capital we had, then we debit retained earnings, and we've done that. Okay, then finally, December 1st, there was 26 million cash received, common stock of 1 million, and gain on previous issue shares of 25 million. Well, we don't get to record that gain. So let me slide. You know what I think I'll do is slide this down so we can see the transaction down here, and then I'll put this up on top, and we can see right in here is the proper way to record that. So we record a debit of cash at 26 million to the left of my mouse, a credit of common stock to show the legal capital again being issued, and paid-in capital in excess of par of 25 million. So there would not be we never record a gain on trading in our own stock. We don't record a gain or a loss. Instead, we take those differences to paid-in capital and to retained earnings when we've used up any paid-in capital that was previously recorded. Okay, and that's this problem, everyone.